Hey guys, welcome back to the channel here at DTI Information Network. In today's video, we are going to be talking about the credit scoring models. I'm going to go over the two credit scoring models that dictate your credit score. I'm also going to try to do my best to get you to understand the importance of having a high credit score and all the different factors that go into your credit score. I remember when I was first learning about credit, I had no idea why my score would go up, why my score would go down, why it would stay stagnant. And it was so very frustrating to me. It wasn't until I got deeper into understanding that things started to make sense. And then I realized that I actually had the power to be able to get the score that I desired by taking a couple of strategic measures into doing so. When I learned this, I said, you know what? This is something that I wish I would have known years ago because I would have been so far ahead of where I'm at today. And then I said, I took it upon myself and I said, I want to share this information with the world and make sure that everybody can grasp it and get it because this is, I feel, the information that was not really taught to us in school. And then, when I started learning even more and going deeper, I even realized my parents didn't even know that much about this. And now I know why. You know why? It's because that this information just became really relevant in the 1990s. So let me give you guys a little bit of history behind the scoring models. The scoring models we're going to be talking about today are your FICO score and your Vantage score. These are the two scoring models that are widely used today to determine your credit worthiness. So let me just give you a little bit of a history and understanding behind these two companies. First, let me let you understand that FICO stands for Fair Isaac Corporation. Okay, the Fair Isaac Corporation, which was founded in 1956 by an engineer named William R. Bill Fair and a mathematician named Earl J. Isaac. And that's how they came up with the name Fair Isaac Corporation. Those are their two last names. All right. The first general purpose of FICO score was introduced in 1989. It was designed to help lenders make more informed decisions about the likelihood that a borrower would default on their loan. All right. So then it became really widely like it just picked up speed in the standard scoring model in in the United States in the 1990s, in like the mid 1990s. So when I was just becoming a teenager, when I was just a teenager, this scoring model was starting to happen. So my parents didn't even have the education probably at that time to give me this information to set me up on my way, the correct way. My parents would tell me things like, don't get too many credit cards. You don't want to have more than three, right? Make sure you always pay your bills on time, right? But that's generic and that's basic. And everybody knows the basic and fundamentals behind that part, right? Well, I didn't understand the depths that I'm going to be teaching you guys today. So, in understanding the FICO scoring model system, um, over the years, FICO has adopted like the scoring model to reflect changes in consumer behavior. Notable, they had the FICO 8 and they had the FICO 9, which I'm going to be talking to you guys about. And now they've even gone into the FICO 10. I'm going to be talking and discussing that a little bit more in depth just a minute. So, I would say the FICO score is used for about 90% of the lending decisions in the United States, making up crucially both lenders and consumers. All right. It's a tool for lenders and consumers. So let's also talk about the next model. The next model is the Vantage score. Now, the Vantage score, all right, now the Vantage score is a little tricky. I just want you guys to understand. There are three credit reporting agencies. That's TransUnion, Equifax, and Experian. Those are the three credit reporting agencies, and please do not give them the power of calling them credit bureaus. They are credit reporting agencies. They are companies, okay? Like you can have a company and I can have a company. That's all they are. They're information housing companies. That's it. But they are very powerful because they house all the information from all the different consumers and even much more. But in 2006, they created the Vantage Score, right? They created their own scoring model system, those three corporations. And their purpose was to develop an alternative to the FICO score. And their reasoning was that it would offer greater consistency across all three credit reporting agencies. All right. A lot of time people are going to call them bureaus. They're agencies. They are not government run run bureaus. Okay, they are just agencies, separate private corporations. So the Vantage Score, I mean, it has gone through some different versions. The Vantage Score is like they had a Vantage Score. It started off with the Vantage 1.0 in 2006, and then it went to 2.0 in 2010 and 4.0, I think it was in 2017, right? And I'm going to go over those different scoring models with you guys in just a moment here, but I wanted to give you a brief understanding behind the different ones. And I'm going to talk to you guys about what each one, how each score is made up. And then I'm going to tell you about which ones use which mostly when it comes to your lending profile. Okay, so let's start off talking about your FICO score. Your FICO score is made up by five different components. The first component is your payment history. I can't stress to you guys enough how much this is the biggest factor of all of them. As you can see in the FICO scoring model, they use and they weight this one as 35% of your score. So your score can go all the way up to an 850 with the FICO score, right? So as low as so as high up as 850. Now this means if you are late on a payment, you're going to drop your score potentially 35%. That's over 200 points. So you can go from one day being at an 800 credit score to the next day sitting in the 600s, just that fast. So when someone brags about their credit score, they're only one late payment from being either where you're at or below where you're at. All right, that quickly. Now, your payment history is so important. There's different techniques and strategies we use to making sure that you do not get a late payment on your credit score. That's by being organized with your credit cards, and then your loans, making sure you put everything on minimum payment. All right. Put everything on minimum payment, even if you don't have enough money to cover it. At least you'll know that if it hits, you better hurry up and make your payment. So if you have a credit card or a loan or something that's due, it will not report on your credit report till 30 days after you're late. Okay, very important to know. So if your due date is today and you are late tomorrow or the next day, that's okay because it's not going to report to the credit reporting agencies and ding your credit score unless you go 30 days from that due date. All right, 30 days from that due date. Please understand that part. That's something that a lot of people don't really understand. Now, granted, you will get hit probably with a late fee and higher interest if you're late, but you won't get reported on the credit reporting agencies, and that's what we care about most. All right. So the second part that goes into your credit score is your utilization. Your utilization is basically how much debt you're carrying. Okay. Meaning if you have a credit card and you have, say, $1,000 credit limit and you only make the minimum payment of $50 this month, that means you are carrying $950 of utilization, right? That also means that you're at 90 something percent utilization on that particular card. Now, when your utilization is over 30%, you're going to get hit and dinged on your credit score. Okay, if you max out a credit card and do not make your payment, and you only make the minimum payment, you have the potential of losing 30% of your credit score. That is the second most important thing, and this is one of the things that are hurting people the most in the United States is high utilization, right? When they can't make their payments in full every single month. Now, you're going to hear different stories about what the best utilization is. Some people will say you just have to have it under 30%. Some people will say, oh, the optimal is 10%. Well, studies have shown that the best that you can have your utilization is between 1 and 6%. Okay, that is when it favors the algorithm the best. Now, I'm not saying that you shouldn't pay your bills off completely off on time. Yes, pay them off on time. That's ideal. Pay to zero balance. That's fine. You're still going to have a really high credit score. Now, when you start getting over 30% of your utilization, that is when it's going to start really affecting your credit score the most. So, highly, highly recommend that you do and take certain strategies to getting your utilization under control and down. This credit utilization hell is the one thing that hurts people the most. I actually did a video on being in credit utilization hell, and you can look inside of our videos that we have. It'll give you different strategies and tips if that is where you're at right now of getting yourself out. All right. The next one is the age of your credit. So I'm talking about your revolving credit when it comes to the age of your credit. Now, how I like to explain it is, let's say if you have two credit cards, right? You have two credit cards. One credit card you've had for 10 years. 10 solid years you've had this credit card, this one credit card, but then you realize that, hey, guess what? Navy Federal has a special right now, and you want to grab their credit card because um, you want to take advantage of the different reward points that it has to offer. So you grab that and you apply for that and you get another credit card. Now you have two credit cards. Well, what they're going to do is they're going to take that 10 years that you had on one card. Now you have zero on another, but you have two cards. So you divide that and you actually now have 5 years worth of age on your credit score. Okay. Now that is actually the optimal place you want to be. You don't want to be below 5 years. So then let's say Chase has an actual special going on right now. If you get that Chase card, that'd be three different cards that you have, but that'd be two new cards, and that's going to take your score to under 3 years. So now you're sitting and you're going to start affecting the percentage of your credit score when you have too many new recent accounts. Okay, so it's very important that you take this into consideration. One of the methods you can do to increase your age is you can hop on one of your family members or friends' credit cards if you're getting ready to apply for something as an authorized user if they have age on their credit, right? If they have a credit card that they've had for 10 plus years and you want to make sure that your age doesn't go down too far, if you hop on as an authorized user on their account, you then will be able to take advantage of having a higher age on yours. So that is a good strategy and technique if you are trying to boost the age of your overall credit. If you are somebody who is new and doesn't have a lot of credit, but let's say you're a family member like your mom or your dad, brother or sister, or somebody you know that you're close with has credit cards that you can actually hop on as an authorized user, you can take on their good age of their credit. So highly recommend you guys take advantage of those strategies. These are all tips to give you the power of boosting your credit score, you guys. This is the stuff that I did not know. I will let you know though, if you are dealing with somebody and you're getting on their credit card, you better make sure that they are paying their payments off. There's no late payments or anything like that, because all that negative stuff can affect you as well. The positive you get, but also the negative. Okay, so do remember that. Make sure whoever you jump on is a a responsible consumer. Okay. The next part is credit mix. Credit mix is meaning how many revolving accounts you have. When I say revolving, it means things like credit cards. That's a revolving. That means if you use it and you pay it off, you get the money back to use it again. So it's constantly revolving. Same thing with a line of credit, a personal line of credit, or a business line of credit. These are revolving accounts, right? You use it, you pay it off, you use it, you get to use that same amount again over and over and over again. That's revolving. Okay. Now, the other one is where you have installment accounts. Installment account is something like your car payment that you have to pay. Well, when you make your car payment, it just goes down to bringing down the balance of that you owe every single month, but you don't necessarily get to use that money again. But that makes it an installment account. It could be something like your mortgage or a loan that you get from the bank. Those are installment accounts. These are different kinds of mixes of your credit. So optimally, you want to make sure that you have a minimum of three revolving accounts and at least two installment accounts. Anything that you can show on your credit report that shows that you pay your bills on time is a good thing to have, and it shows good credit mix to have. So having an auto loan, having a mortgage, having credit cards, these are all the different mixes that go and play in, and they can count for about 10% of your credit score. So they like to be able to see a good credit mix with the algorithm. The other one I want to let you guys know about are hard inquiries. Okay, a hard inquiry is when you apply for credit at a lender institution and they run you to check your credit worthiness. They hit you with something called an inquiry, a hard inquiry. Sometimes you can find lenders that will give you a soft inquiry where they're not reporting it to the credit reporting agencies that count against you. But if it's a hard inquiry, and it can start affecting you. If you have more than four hard inquiries on your credit report, you can start getting hit with getting your credit score hit with 10%, losing 10% of your score is what I'm trying to say. So making sure that your hard inquiries are under control and you don't have that many reporting. Now, hard inquiries stay on your credit report for 2 years. Okay, so after 2 years, they should not be reporting on your credit report any longer. But understand that if you have 5, 6, 7 hard inquiries on your credit report, that can be a huge determining factor of you getting denied for credit. That can be letting the creditors know that, this person looks a little too thirsty. There's a reason why they're searching for so much credit all over the place. You look a little risky. We're going to hold off on you, right? And some lenders are more, I would say, they are more what we call uh, inquiry sensitive, right? Some lenders aren't so much, some lenders are, and they all have their own way of determining if that is a criteria that you meet or a requirement that you meet. If you have like 5 inquiries, they could be like, you know what, that's too many inquiries, denied. Or if you have 7 or 8 for one lender, they may not really care about the inquiries so much, right? They take more of the relationship that you have with that particular bank into consideration more. So if you have hard inquiries on your credit report, you have to understand that you cannot have too many when you are applying for credit. All right. It's a big factor of why people get denied. I wanted to make sure I let you guys know that one. Okay. So we talked about the FICO score, you guys. Now let's go ahead and let's talk about the Vantage scoring system. So the Vantage scoring system, as you can see, it's a little bit different. Now that I've given you a little bit of a history between what the payment history is, the age, the utilization, and all that kind of stuff, I can go through this a little bit faster. But if you can see here that the compared to what the FICO was with payment history, there's a 5% difference. So the Vantage scoring model, they're looking heavily at your payment history. If you have a late payment, they weigh that even more than what the FICO scoring system does. And then they also weigh your the age in the mix together as 21% of your credit score. And your utilization is 20% instead of the 30% that you saw on FICO. And then the total balances that you have, they count for that. The total balance debt that you're carrying as 11%. But as you notice here, hard inquiries, they only account for 5%. So this, and then available credit is 3%, right? So what I'm trying to get you to understand is that sometimes if you're getting hit with a Vantage score, it's going to be different than what you're getting hit with a FICO score, right? And this is why these numbers can be slightly different than the other. Okay, very important to understand that. Now, I will say a Vantage score that you're going to see in the marketplace really often is Credit Karma. A lot of people use Credit Karma because it's free and you can see all your accounts, and then you're seeing that you have a certain credit score, right? So you're going to see that you have a certain credit score there. And then with that, with let's say Credit Karma, you may think that, hey, look, I have a 750 credit score, I'm good, right? And you go to apply at a certain bank and they're telling you that no, you have like a 660 with us. And they're using a FICO scoring model system, and you got it off Credit Karma, and you're thinking that, oh, look, Credit Karma said I had this scoring, but they're using a Vantage scoring, and that is the difference. Okay, they're taking different things into the algorithm to determining your score. Very important to know. All right. So, who are some people who use the Vantage scoring system? That is people like landlords and property managers can often use that to screen potential tenants. Telecommunications companies like T-Mobile and Verizon and those kinds of things, they can also use the Vantage score to determine if they should give you a service contract and finance your plan or not. Utility companies can also use this. So one thing to understand is that they're paying for this scoring model system to use to determine your credit worthiness. So sometimes it may be cheaper for them to use a Vantage score compared to using a FICO score. So you have to be very understanding of your scoring systems that you have. All right. Insurance companies can also use the Vantage score to assess your risk assessments. Employers, some employers will look at your credit and your background checks to determine if they want to hire you or not. Some employers will not hire you if you have negative things reporting on your credit report, because that could be a determining factor if you're risky for them to hire you, because you might be dealing with sensitive information. You might be in a situation where you could be put at risk. And if you have poor credit, it's also it also shows how well you take care of your finances, how well you take care of your bills. So very important to understand that. Now, who uses the FICO scores? Now, this is where we get into like the national banks and the credit unions and the mortgage lenders. So, a lot of times, guys, this is what we're using. We're using our FICO scores because right now we are talking about getting credit from the banks. We're talking about going in and getting high limit credit cards with reward points, and you're getting those from your national banks and your credit unions. And then also mortgage lenders and other kind of financial lenders, commercial lenders and such. They are widely using the FICO scoring system. All right. Very important to know. Now, I will let you know, since we're talking about the FICO scoring system, it is complex. There are different FICO scoring models, and it is so hard to determine and know which one they're using. You won't know. A lot of times you don't know. And each one uses a different type of the algorithm. So I was just showing you guys the different things that they weigh it on. Well, these ones, the FICO scoring systems, use different models, right? So they may weigh a little bit more or a little bit less on certain things like age, or certain things on utilization and payment history. So it gets really, really complex. But just so you guys know, right now, the most widely used one is your FICO 8. Okay, and that is the scoring model system that I showed you guys previously. There are newer versions like the FICO 9, and then the newest version right now is the FICO 10. It's not widely used right now, but it is to come. The FICO 10 is where they're going to actually take a trailing account and not just look at what your credit score shows right now, but they're going to be looking at months past and how you did those months to determine your score. All right. So, and it's usually really industry specific. Okay. Then you have the FICO auto scoring system. When you're going to get an auto loan, you'll notice that your FICO score for your auto loan is higher a lot of times than what it may be for getting a actual credit card. Well, that's because they use a different scoring model, and it's a more lenient on a lot of different things. So you can have a higher auto FICO score. And then there's the FICO score 2, 4, and 5. That is the older model, and sometimes a lot of mortgage lenders are still using these particular FICO scoring models. FICO Score 2 is used by Experian, and FICO Score 4 was widely used by TransUnion, and FICO Score 5 was widely used by Equifax for mortgage lending. All right, so I kind of wanted to go over that with you guys. Very important to know. There's just a lot of different scoring, FICO scoring models. I put them here for you guys to screenshot this or also take it with you. I hope it's helpful for you. All right, let's talk about the scoring ranges. So your scoring range for a FICO is anywhere from a 300 to an 850. And I put the scoring models here from if you're in 300 to 579, that's considered poor. 580 to 669 is considered fair. 670 to 739 is considered good. And a 740 to 799 is very good. And excellent is the 800 club from 800 to 850. Well, I will let you guys know one thing. If you have a 760 or above, it will get you everything that an 800 credit score will get you. All right. So I always say make the 760 your goal. If you get to the 800, that's a bonus and a cherry on top. All right. But a 760 is going to get you the same things that an 800 or an 850 is going to get you. Now, Vantage Score range is quite similar, but it goes for a very poor 300 to 499, and 500 to 600 is poor, and 601 to 660 is fair, and then 661 to 780 is good, and then as low as 781 all the way up to 850 is excellent on that model. All right, so I wanted to make sure I gave you guys this little insight. I hope it was helpful. I hope you guys got some value out of this. If you did, how I ask is that you hit the like button, subscribe to the channel. We want to give you more in-depth content like this, but I don't know if it was valuable to you guys or if you learned anything unless you comment or hit the like button and subscribe to the channel. All right. So if you like this kind of content, let me know. I also want to let you guys know we do have a private VIP school group community. If you want to learn more information about our company, DTI Financial Literacy, where we have resources and we help you build out your credit. We also have a do-it-yourself where we can teach you how to do yourself, fix your credit yourself and build your credit score up yourself. And if you need help doing it, we have coaches to help you do it as well. We have a private school group community. Inside of that, you're going to be able to find that link to be able to get that inside of our website. You can go to our website, which is listed right here, or inside of the description of this video, you can find our private school group community where we're gathering like-minded individuals, where we're talking more about personal credit, business credit. We're talking about real estate. We're talking about business acquisitions. And I have coaches and other people in my network inside of this community to help give you guys more information and help you guys level up to the next level. All right. So thanks again for dropping by. Check out some of the other videos that we have inside of this particular YouTube channel. We're trying to grow it up and get it to that high mark so that it can get across the world and get across to everybody to help them as well. So once again, thank you guys for stopping by. We will see you on the next video. All right. Peace.